All right, in this lesson, we are going to go over the basics of the accounting process. These are some of the things that you should know when it comes to transaction analysis and what accountants do when we account for the data that we receive related to the finances of a company. So let's start here with talking about documentation. Now, accounting is based in part by what we would call evidence. And so accountants need evidence to back up the work they do. We call this process as documentation. So accountants, before we actually book anything into the accounting cycle or the accounting process, we have to have some type of evidence. That evidence helps us ensure that if someone else was to take their seat at that accounting desk, they could recreate all the work that the other accountant did based on the documentation, based on the evidence that that other accountant received. So we don't just willy-nilly book transactions to the book. We have to have some type of document, some type of evidence to substantiate the transaction that we enter into the financial books of a company. And so that's super important at the end of the day, is that what type of documentation can we have to support the transactions that we're booking into the books. Now, documentation or evidence can be in any real form. Typically, these are examples of the form that we would get them in. They include receipts, invoices, canceled checks, certificates, or really any other form that legitimizes the transaction. Now, I'll tell you this, that typically we want to see third-party evidence more than we want to see internally created evidence. So for instance, a receipt, we want to see that from the vendor rather than seeing it from, someone in-house creating a receipt because they lost the receipt. Does that happen? Absolutely. And so we still have to document it. So we just create, I wouldn't say it's a fake receipt. We're creating a duplicate receipt as best we can, and usually it's just on a piece of paper saying that, bought one, blah, 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 from here and here, and this is the amount. As long as we don't have too many of them, then we're okay with it. It's just we happen to lose that receipt. So third-party receipts, third-party documentation is much better because we can verify that with a third party than internally. Does that mean that we don't have internal documentation? No, that's not the case at all. So one of the things that you're going to learn later on is depreciation, which is a calculation. And nobody else is going to give us that calculation other than the accountants, who have to actually do the calculations to figure out how much depreciation expense we're going to put into the books. And so that's an internally created document. There's no way we could get that from an outsider, so we're okay with that. So generally speaking, we love to get third-party type of evidence, but if we can't, internally generated evidence is good enough. We just don't want to have a lot of it if there are other ways we can get documentation or evidence from the outside. Now, every transaction that we'll talk about here in accounting has a give and take. What does that mean? Well, in a sense, it means that every transaction that we book into the accounting system, we as the company are either going to give up something for getting something in return. That's what every transaction is all about. So here is an example. For example, you pay cash for a new cell phone. For the company, what did they give up? Well, they gave up a cell phone. We call that inventory. They gave up a cell phone and inventory. And what did they get back in exchange? They got back cash. So every exchange, every transaction that we'll look at has a give and a take. And we're going to do some examples with give and take, and you'll kind of get a better idea of how this all works. So give and take is every transaction. If there is no give and there's no take, then there is no transaction. So we'll talk about that later on. That's like promises. If we have promises, there is no give and take. That's just a promise. There actually have to be an exchange of something in order for a transaction to occur. Now, when we talk about the balance sheet specifically, we might be thinking about what numbers do we need to put into the transaction. Well, there is a principle that accountants have to follow. It's called the cost principle. The cost principle tells us that on the balance sheet, we report any number that goes on the financial reports at cost when we pay for it in an open market. We do not report fair value. So let me give you an example of this. Let's assume that you go out to a dealership and you get a really good deal on a new car. So on that new car, it's valued at $20,000, but you, for whatever reason, got it for $15,000. So it's worth $20,000. You could technically resell it for $20,000, not regarding depreciation, but you could sell it for $20,000 now, but you only bought it for $15,000. So you got a $5,000 equity bump. And so when we talk about what do we put it on our books, how much do we report on our financial statement, it would make sense that we would put $20,000 because that's what it's worth. And if the balance sheet is supposed to accurately say what we own this car that's worth $20,000, so we're going to book it at $20,000. What the cost principle tells us is that we only report our assets, our liabilities, our owner's equity, even our revenues and expenses and dividends at cost. What did it actually cost us at the end of the day? So instead of reporting $20,000 for that new car, we're only going to report $15,000. So if you are given a problem where it says that's worth this and you paid this, then the amount that you're going to book is the amount you paid, not necessarily what it's worth. And again, if you want a real life example, you can think of McDonald's. McDonald's back 30, 40 years ago, acquired a lot of different lands at very profitable intersections or very highly sought off intersections or thoroughways. And so they might have paid $15,000 for a street corner in the middle of New York City, and now it's worth $55,000, let's say. And so in their books, it's still $15,000, even though it's worth $55,000. So obviously McDonald's would love to show their balance sheet bigger, that their assets are worth $55,000, but that piece of land didn't cost them $55,000, it cost them $15,000. And so that's what goes on the book. So remember, cost, not fair value. So that's a look at the basics of the accounting process. Those are some of the things you should understand about the accounting process. We've got the give and take, and we've got putting things at cost, and then we need to document or have evidence that helps supports the transactions we enter into the accounting system. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.